Welcome to my channel. Here we talk about finance, investing, and how to take steps towards your first million.
We cut through the noise to get you the insights you need. Today, we're tackling something many of us look at with, well, a mix of interest and maybe a little bit of fear: investing. It often feels like this super complex world, right? Full of jargon, confusing charts. You feel like you need a finance degree just to start. We all want our money to grow, obviously, but getting started without feeling totally overwhelmed, that's the challenge. So what if there was a way? A simpler but really powerful way to build wealth. Something backed by finance heavyweights that doesn't need you watching the market every second. That's exactly what we're getting into today. Our deep dive is all about index funds. You've probably heard the term, maybe quite a bit, but you might not have grasped just how much of a game changer they can be. Our guide for this is the Intelligent Investor's Guide to Index Funds. And our job really is to break it down for you. Cut through that complexity, pull out the key stuff that can actually empower your financial journey.
Absolutely. And this is so relevant right now, isn't it? If you're looking for that straightforward, long-term way to invest, something that doesn't demand you become some kind of stock-picking expert, then getting your head around index funds is, well, it's fundamental. It's really not about chasing the latest hot tip. It's about understanding and using a proven, accessible tool, something that can be a real foundation for your finances, letting time do the hard work for you.
Okay, let's unpack that. Index fund, we hear it all the time.
Yeah.
But for someone new to this, or even someone who follows finance but finds the term a bit fuzzy, what is an index fund, really, at its core?
Yeah, good question. So fundamentally, an index fund is a type of investment fund. It could be a mutual fund or often an ETF, an exchange-traded fund. You hear a lot about ETFs these days. People like how easily they trade. But the key thing, the absolute crucial element, is its goal. It simply tracks a specific market index. That's its job.
Tracks an index, so it's not trying to be clever or beat anything. It's just following. Yeah. Now, what exactly is a market index then? What's it representing?
Think of it like a list or maybe a basket of investments, usually stocks that represents a specific part of the market. It's a benchmark. The classic example, and the source talks a lot about this, is the S&P 500. That's not just 500 random stocks. It specifically tracks the 500 largest U.S. companies traded publicly, covers a huge range of industries. Or you've got the NASDAQ Q100, that one's more tech-heavy, tracking the 100 largest non-financial firms on the NASDAQ. Then there's the Dow Jones Industrial Average, older, smaller, just 30 big established U.S. companies. Each index gives you a different snapshot, you see.
Got it. Different snapshots of the market. And this is where the real insight comes in, right? Instead of fund managers trying to constantly beat the market, which sounds exhausting and frankly difficult, index funds just aim to mirror the performance of whatever index they're tracking as closely as possible. So it's a passive approach. No active stock picking.
Exactly. No manager making bets on which stock will soar or plummet. The fund basically automatically holds all, or sometimes a very representative sample, of the stocks or bonds that are in the index it's tracking. And that shift in thinking from beating the market to just matching it, it's actually pretty revolutionary when you think about the data. Study after study shows that most active fund managers, the ones trying to pick winners, they actually fail to consistently beat their benchmark index over the long haul, especially once you factor in their higher fees.
Fail to beat it? How many?
Well, the numbers are pretty stark. We're often talking something like 85%, maybe even 90% of large cap active funds falling short over, say, a 15-year period. So index funds offer this powerful but much simpler alternative. It's like saying, okay, trying to pick the winners is really hard and expensive. Let's just buy the whole market or a big chunk of it and ride its overall progress.
Wow, 85, 90%. That really puts it in perspective. It sounds almost too simple, especially if you've been led to believe investing has to be complicated. So if the goal is just mirroring, how does that actually work? Like mechanically, what are the nuts and bolts?
It's actually quite elegant, really. First, it's all about tracking the index. The fund manager's job is basically to buy all the assets in that index or a statistically sound sample of them, and crucially, hold them in the same proportions as the index itself. So if, say, Microsoft is 6% of the S&P 500, the fund makes sure Microsoft is 6% of its holdings. It's replication, not opinion.
Okay, strict replication.
Right. Second, as you said, it's passive management. No team of analysts constantly researching and trading, trying to get an edge. They just follow the index rules. This dramatically cuts down on research and trading costs.
Lower costs? Makes sense.
Third, that structure naturally gives you fantastic diversification. An index like the S&P 500 holds 500 companies across different sectors. So when you buy one share of that index fund, boom, you're instantly diversified across all of them. You're not putting all your eggs in one basket. It spreads the risk.
Way easier than buying 500 stocks yourself.
Oh, absolutely. Imagine the commissions. And finally, this leads to low turnover. Because the index components don't change that often, the fund doesn't need to do a lot of buying and selling, maybe just occasional rebalancing. Less trading means lower transaction costs, and importantly, if you hold it outside a retirement account, potentially fewer taxable capital gains distributions. That's a subtle but powerful long-term benefit.
Okay, so low turnover plus diversification. It really does sound like an efficient system. It directly addresses that desire for something simpler, something less expensive, doesn't it? No high fees for active management, no need for you to constantly research individual companies. It's kind of amazing that this concept, which seems so logical now, is actually not that old in the grand scheme of things. Who came up with this? And you mentioned different types earlier. Let's explore that. How varied are index funds?
Yeah, the history is interesting. The very first index fund available to the public was launched in 1976. It was created by John Bogle, the founder of Vanguard. He was a real visionary, pushing this idea that investors could do better just by matching the market at a very low cost. He really democratized investing for ordinary people.
John Bogle, Vanguard,
Okay.
1976. Relatively recent, really.
It is, in investment terms. Now, about the variety. You're right, it's not just one thing. The source material lays out several main types, which lets you, the investor, target different areas. First up, the most common are equity index funds, or stock index funds. These track stock market indices. Think S&P 500, Russell 2000 for smaller U.S. companies, maybe international ones like the UK's FTSE 100. These are generally your main growth drivers.
Right, tracking stocks.
Then you have bond index funds. These follow bond indices, like the Bloomberg U.S. Aggregate Bond Index. Bonds play a different role, often providing income and stability, acting as a counterbalance to stocks. So these funds give you easy access to that asset class.
Stocks and bonds, the main building blocks.
Exactly. You can also get international index funds. These track indices of companies outside your home country. Super important for diversification, getting exposure to global growth.
Makes sense. Don't want all your investments tied to one country's economy.
Precisely. And finally, there are sector index funds. These are more specialized. They focus on one specific industry, like technology or healthcare or energy. These let you make a targeted bet on a sector you think will do well, but using that low-cost index structure. The flip side is they are less diversified than broad market funds, so they carry more specific risk.
So you can go broad, or you can get quite specific, all using this index fund approach.
No.
Lots of flexibility there without adding huge complexity.
Okay, given all the mechanics, the variety, it's pretty clear why index funds get so much praise. But let's really hammer down the core benefits. For someone thinking, okay, should I use these? What are the absolute killer arguments?
The case is really compelling, and the source emphasizes a few key things. First, and maybe the biggest draw for many, is low costs. We touched on this, but it's worth repeating. Passive management means much lower fees, the expense ratio. For an S&P 500 index fund, you might pay just 0.03% to 0.10% per year. Compare that to active funds, charging anywhere from 0.5% to maybe 2% or even more.
That difference sounds small, 0.03% versus, say, 1%. But over time, oh, it's huge. Over decades of investing, that difference in fees can literally add up to tens, even hundreds of thousands of dollars that stay in your pocket, compounding for you, instead of going to the fund company. It's maybe the most powerful factor in long-term returns.
Wow. Okay, low cost is huge. What else?
Second, that automatic diversification. One purchase and you own a piece of hundreds, maybe thousands of companies. That drastically cuts down the risk of any single company blowing up your portfolio.
Instant safety in numbers.
Pretty much. Third, remember that statistic, performance. The hard truth is most active managers don't beat the market consistently, especially after fees. Index funds guarantee you the market's return, minus that tiny fee. Over the long term, that average return often ends up being better than what most high-fee active funds deliver. It's consistent.
So you're not paying more for likely underperformance.
That's the irony, yes. Then there's transparency. The fund just holds the stocks in the index. You know exactly what you own. No hidden bets, no complex strategies you don't understand.
Clear and simple.
And finally, that leads to overall simplicity. For long-term investors who want a strategy they can stick with, without constant tinkering or stress, index funds are almost ideal. It's a set it and potentially forget it approach. relatively speaking.
Yeah, those benefits really stack up. Less cost, less risk through diversification, solid performance historically, transparency, simplicity. It sounds like a recipe for less financial stress, doesn't it? Makes investing seem much more manageable, more predictable, perhaps, over the long run. But look, no investment is perfect, right? It sounds fantastic, but surely there are downsides or risks we need to be aware of.
Absolutely, that's a crucial point. Index funds are great, but they aren't magic. Understanding the limitations is key. The big one is market risk. Index funds track the market, so if the whole market goes down, your index fund will go down with it. There's no active manager trying to dodge the downturn. You ride the market roller coaster up and down.
So no protection from market crashes.
None, inherently. You're buying the market, warts and all. Second, there's limited flexibility. You own everything in the index, including the companies that might be underperforming. You can't say, oh, I don't like company X, I want the fund to sell it. Nope. If it's in the index, it's in your fund. You can't customize the holdings within the fund.
You're stuck with the laggards as well as the leaders.
Exactly. And finally, remember the goal. They deliver average returns only. By design, they match the market. They don't beat it. So if your ambition is to find investments that significantly outperform the market averages, a broad index fund isn't the tool for that specific job. It's built for market participation, not outperformance.
Right. So know what you're signing up for. Market returns, both good and bad, with no ability to pick and choose within the index and no chance of beating the average. Those are really important trade-offs to understand. It helps you align the tool with your actual goals and risk tolerance. Okay, let's make this even more concrete. Can we walk through a simple practical example? How does this actually look for someone putting money in?
Definitely. And first, just to reiterate accessibility. Index funds are easy to buy. Through any standard online brokerage in retirement accounts like RRSPs or TFSAs here in Canada, or often as ETFs which trade like stocks throughout the day.
So easy to access. Now the example.
Right. Let's say you decide, okay, I'm going to invest $1,000, and you choose a popular option, an S&P 500 index fund, maybe as an ETF. The moment your trade goes through, that $1,000 is instantly invested across all 500 of those large U.S. companies. A little bit in Apple, a bit in Microsoft, Amazon, Google, all the way down the list, proportional to their size in the index.
Just like that. $1,000 spread across 500 companies.
Just like that. Now, let's say over the next year, the S&P 500 index itself goes up by 10%. Your $1,000 investment will also grow by roughly 10%, becoming about $1,100, minus, of course, that very small expense ratio, maybe a few dollars in this case. The point is, you didn't have to research 500 companies. You didn't have to decide when to buy or sell. You just participated in the overall growth or decline of that large slice of the U.S. market. The fund handled the mechanics.
That really highlights the set-and-forget nature, doesn't it? Leverages the whole market's power with minimal effort and cost on your part. So wrapping this up, what's the core takeaway message from our sources, the bottom line for you listening? It seems to be this. An index fund is fundamentally a simple, very low-cost, and automatically diversified way to invest, particularly in the stock market. And its defining feature is that it's designed to match market performance, not try to beat it.
Exactly. And the evidence strongly suggests that over the long term, this approach delivers solid returns for most people, while crucially minimizing those wealth-eroding fees and avoiding the risks of trying, and often failing, to pick individual winners. It really is a powerful demonstration of how consistency and broad market exposure can win out over complexity and high costs in investing. It's kind of a less is more victory.
So here's a thought to leave you with. How might truly embracing this idea of simplicity and consistency, instead of chasing elusive big wins or complex strategies, change your approach to building long-term financial well-being, and maybe even your peace of mind? Something to think about as you consider how these principles might fit into your own financial planning. Thanks for joining us for this deep dive.